Every single day, trillions, literally trillions of dollars flow through global markets. Capital is just continuously, relentlessly reallocated. Welcome to this explainer. Today we're going to unpack the absolute foundation of this massive economic engine by looking at the nature and objectives of financial reporting. It's what a lot of people call the language of business, but as we'll see, it's so much more than that. It is the vital system keeping the global economy afloat.
So, here's the big question we have to tackle. How do outsiders look inside a highly complex multinational corporation and figure out if it's a wealth-generating powerhouse or a sinking ship? I mean, you can't exactly just stroll into headquarters and start digging through their filing cabinets, right? The answer is financial reporting. It's a highly structured mechanism designed specifically to reduce that information asymmetry between the folks managing the firm and the folks providing the capital. All right, let's map out our route for this explainer. We've got 4 main stops today: the nature of reporting, core reporting objectives, the qualitative characteristics, and finally, the evolving landscape.
Okay, Section 1, the nature of reporting. Let's do some demystifying of the numbers here to understand what financial reporting actually is and, honestly, what its limitations are. You know, it's incredibly easy to glance at a beautifully formatted balance sheet and just assume you're looking at absolute hard reality. But there are 4 core traits that define the true nature of financial reporting. It's historical, relies heavily on estimates, has a strict quantitative focus, and is governed by standardization. Let's break these down, because misunderstanding them is exactly where a lot of investors make their first big mistake. First up, financial reporting is inherently historical. Think of it as a rearview mirror. Now, management loves to include optimistic forecasts in their press releases for sure, but the core financial statements only record events that have already happened. We're looking strictly at the financial consequences of past decisions here, not gazing into a crystal ball. And that brings us to the second point. We really need to bust this myth of absolute precision. Despite seeing neat rows of numbers extending all the way down to the decimal point, the reality involves heavy reliance on estimates and professional judgments. Things like depreciation schedules or the impairment of goodwill, they require subjective assumptions about a totally unknown future. So it's an approximation of economic reality, not an exact science. Third thing to keep in mind, we're dealing with purely quantitative data. This means the picture we get is crucial, absolutely, but undeniably incomplete. It only captures what can be measured in financial terms. If a firm has an incredibly motivated workforce or unparalleled brand loyalty, well, human brilliance just doesn't fit neatly onto a balance sheet. Those massive, non-financial assets are left entirely out of the bath. Finally, this whole process is governed by standardization. Whether a firm uses GAAP or IFRS, they have to conform to a shared framework. And this is the magic ingredient, right? It's what allows an investor to fairly compare a sleek tech startup in California with a massive manufacturing plant in Germany. Without this standard rulebook, capital markets would just be absolute chaos. Moving right along to Section 2, core reporting objectives. This is the why behind all this rigorous, highly regulated data. The primary objective boils down to one simple but profound concept: decision usefulness. The goal is providing the essential baseline data that external users actually need to assess the amount, timing, and uncertainty of future cash flows. It's all about helping people make informed resource decisions. In practice, it looks like this. Shareholders want to model future cash flows and assess the capacity for dividends to predict growth. Creditors, they want to make sure the firm can actually service its debt. And even though these reports are a rearview mirror, both groups use this historical data as a foundation to model those future prospects. Now, here's where it gets really interesting. We run into the classic agency problem, driven by the separation of ownership and control. You have shareholders who own the firm and executives who run it on a day-to-day basis. Which begs the ultimate question. Are the executives actually creating shareholder wealth, or are they destroying it? Financial reporting acts as this vital monitoring mechanism to evaluate management stewardship. It helps owners judge if, say, a major strategic divestiture was truly valuable, or if it was just some clever financial engineering. Basically, it holds management's feet to the fire. Section 3, the qualitative characteristics. Basically, trusting the numbers and knowing they're actually up to the task. If we're going to make these high-stakes capital allocation decisions, the data provided has to possess 2 fundamental characteristics:
relevance, and faithful representation. Honestly, without both of these working together, the entire system completely collapses. Data is relevant if it actually helps forecast future outcomes or confirms past expectations. But relevance means nothing without faithful representation. The numbers have to accurately reflect economic phenomena, meaning they need to be complete, perfectly neutral, so no bias or manipulation, and totally free from material error.
When you've got both relevance and faithful representation, it sets off this incredible chain reaction. Trust in the numbers goes way up, which causes the perceived risk to drop. When risk drops, the firm's cost of capital decreases, and ultimately, wealth creation is completely optimized. It's an absolutely beautiful mechanism when it functions properly. And that brings us to our final stop, Section 4, the evolving landscape, looking beyond the traditional balance sheet. The financial world never really sits still, does it? Today, the demand for information is expanding way beyond traditional financial metrics. Investors are leaning hard into integrated reporting and sustainability disclosures. They want to deeply understand how ESG factors, environmental, social, and governance issues, are impacting long-term enterprise value. But, and this is the crucial takeaway, even as the reporting landscape expands, that core mandate remains completely unchanged. The ultimate objective will always be to illuminate true economic reality and separate the real wealth creators from the wealth destroyers. The tools are definitely adapting, but the mission is exactly the same as it was on day one. So, I'll leave you with this final provocative thought to chew on. As global markets evolve and reporting rapidly expands to include these complex ESG factors, we really have to ask ourselves, are traditional financial metrics still enough to reveal true economic reality? Or is the language of business about to undergo a massive rewrite? Just a little something to ponder the next time you crack open an annual report. Thanks for joining me for this explainer, and I'll see you next time.